Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Disney's another name that kind of was on the radar screen for a lot of investors. They reported numbers last night a little bit better than expected. People are looking at the streaming business. The losses there were a little bit lower. That's good. It's all part of Bob Iger's CEO's plan to cut costs here. But there's as many questions around that company as I've ever seen in my 30 years of covering it. When you see a business like ESPN, which is just the rock solid core of this company for 20, 25 years, now you're wondering whether you even want to own it. Mark Douglas joins us. He's the CEO of Mountain. He knows a thing or two about this business, about the media business, about the digital advertising business. Hey, Mark, you take a look at what is a stalwart media company like Disney, and boy, there are a lot of question marks there. What are some of the key issues for you when you look at Disney?
Well, I think the fundamental issue is Disney, has magical prices for everything they do, meaning the prices are generally pretty high. And I think they're not really delivering magical, experiences or magical content right now. And they keep looking externally for what are the factors that are affecting their business rather than just looking internally. And so even if consumers are spending less money, then deliver the magic and take a bigger share of wallet. But, I think they're full of excuses right now. And until they look at themselves, I think this kind of like we're not doing as well as we used to is going to continue.
So what's the answer on the whole streaming thing? Do streamers really make money, Mark? Because I was listening to Paul interview the head of, I think, SAG-AFTRA, and
right.
She was saying the streamers make $30 billion a year in profits, and they want a piece of it.
Well, I mean, obviously Netflix is definitely making money, and I think you're going to see because Netflix, their ad-supported tier is, off to somewhat of a slow start, but it's just hugely profitable for them. What they're doing in password sharing again is just hugely profitable for them, and my opinion is Netflix is going to kind of enter a new era of just increased earnings. And I think anyone else can get there, but it starts with, people want to be in the parks. People want to watch Star Wars. They want to watch new Disney movies, and they want to do them at the same rates that they have in the past. So I think Disney can absolutely get there. I'm a little concerned that, they're talking about reducing their investment in streaming or moving away from ESPN as if people don't want to watch sports anymore. And so it's as you opened, it's a little bit of just like everything seems to be in turmoil where, I don't think the consumer has actually changed that much. It's Disney's the one that seems to not know exactly the direction they want to go.
Yeah, and that even applies to the film business, which had been, ever since they started buying all these great brands like Pixar, like Marvel, like the Star Wars franchises, it was literally guaranteeing them 2 to 3 to 4 movies per year with a global gross in excess of $1 billion. Now, even that business seems like it might be in a rut. They've delayed and pushed out a lot of release dates. Maybe some people are saying maybe we're oversaturated with some of these franchises. And then, you just look at Barbie, kind of a new original movie. That's over $1 billion in box office. So do you think Walt Disney's lost some of their magic when it comes to the film business, Mark?
Yeah, I think, so we've talked about sports on the show. I mean, when your team's not doing well, everyone needs to remember how to catch the ball and hit, right? Like it's baseball season right now. And the best managers just go back to basics. And I think Disney's problems are not huge if they just go back to basics. And if they go back to basics, they kind of own these huge segments of the market, parents, children, sports, and when you see a company that owns segments of the market, I mean, just like dominates segments of the market like that, and they're a little confused as to what they should do, like just go back to basics, get a little less focus on near-term results in Wall Street, and just essentially kind of grow yourself out of that. And especially when you have the kind of capital that Disney has to do it also. So, I mean, they're not at risk of running out of money unless their losses continue for a very long time. So, I mean, that's my advice as a CEO. Bob Iger obviously is a very smart guy, and he's going to, follow what he thinks is best. And so we'll see how this plays out.
You have any succession advice for Bob?
Well, the last one didn't go well. Didn't go any better than the show, Succession. So I think he's going to have to really fix this before he brings in someone else to grow it. Yeah, so that's it. I don't think he's there for 1 year. I think this is going to take a few years.
I haven't seen the end of Succession, so
we won't,
spoilers.
We won't spoil it for you. Hey, Mark, it's just when you think about Disney, they're like all the media companies really exposed to these strikes that we're seeing with the writers and the actors. You're so involved with the advertising side of the business, the digital side of the business. What's your take on these strikes here? Because boy, both sides seem really entrenched.
Yeah. Well, I think first, from what I understand, the anything that was already in motion on the film side is allowed. That project is allowed to get completed. So it's actually going to take a few more months before, like, literally everything is truly shut down.
Yep.
And then I think the streamers and the studios and things like that. I mean, cash is king. They have a lot of cash to wait this out. So this is it's hard to predict how this is going to go. But if it's a war of attrition or money, that's going to favor these big studios just kind of waiting it out to get a deal that they think is reasonable.
Well, and Disney has an added bonus that Netflix doesn't in the parks business, right? I mean, I heard yesterday they get 70% of their
operating income.
Operating income from the parks.
Well, that's the good news. The bad news is it's because the other businesses have gone down so much.
Exactly. The movies in particular, I think, have really been hurting them.
But you're right. And the parks business is rock solid, has always been.
The big franchises, like, I don't follow all the superhero movies, but that and Star Wars and even Pixar, they just haven't been as successful as they once were, have they?
Yeah, and so I mean that again, the content is a part of the experiences that Disney sells. And so, they have to look inward and say, is this because consumers don't want to watch Star Wars anymore? Or is it because maybe we're not doing the greatest job in giving them what they want? Because if you give them what they want, they're going to watch. And so, it's I'm going to keep beating that drum. It's back to basics to grow this business.
Hey, Mark, give us a sense of kind of the advertising market out there you're so involved in on a day-to-day basis. I can't imagine it's very good because, I mean, I'm just thinking the economic environment is kind of uncertain here. What are you seeing out there just in terms of overall advertising?
Yeah, so if you're a performance advertiser, your Google, your Meta, Meta's up year over year. Even TikTok, Amazon, companies in the performance space, you continue to do quite well.
Okay.
If you're in the brand advertising space, more of the big TV networks, it's a bit up and down. It just literally, I think, month to month, the budgets are going up, they're going down. So it's not like this huge era of growth right now, but it's also not like a bloodbath. I think that the kind of retraction in spending on brand advertising has already occurred. And it's just a little less predictable. But overall, I think, from everyone I talk in the industry, my own experience at Mountain, it's relatively solid,
okay,
given the kind of how much the economy and economic news are just constantly up and down. It's pretty consistent right now.
All right, Mark, great stuff as always. Mark Douglas, President and CEO of Mountain, giving us kind of his thoughts on what we saw from Disney and some of the streamers.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Nice little M&A trade today in the luxury space. Tapestry, again, one of the worst names in the business. They own the brands including Coach and Kate Spade. They agreed to acquire Michael Kors' parent Capri Holdings in an $8.5 billion deal. To break it down for us, Kriti Gupta, host of Bloomberg Surveillance Early Edition, joins us here in our Bloomberg Interactive Broker Studio. Pretty big names here, Kriti. What do you make of it?
Yeah, I don't think Tapestry and Capri necessarily resonates with everyone, but
Right.
when you hear the names Jimmy Choo, Versace, Kate Spade, Coach, perhaps some bells will ring. And look, these are the two parent companies that frankly have both been struggling. We know luxury. When you think luxury, you don't think the U.S. necessarily. You think European luxury. You think
Yes.
Hermes. You think Louis Vuitton, et cetera. But it's the same model that these folks are trying to basically make in the U.S. sphere. The problem is that the appetite for luxury in the U.S. is not the same as it is in Europe or the Middle East or China.
Is that right?
For example.
Why not? Go down Fifth Avenue, go down Madison Avenue. It seems like all the brands are there.
Sure, but that's not a representation of America.
Okay.
I gotta say,
Okay,
and
true.
that's I think where the value add comes.
I gotta get out of Manhattan. every
You
once
gotta
in a while.
go to Dallas, Texas. I'm gonna
Yes.
give you a tour,
Okay.
and I'm gonna show you what it's like to live in
I like Fort
Middle
Worth,
America.
Texas.
Fort Worth, Texas is great.
I like Fort Worth.
And one of the fastest growing cities in the country, I should say. But here's the point. As you have this kind of wealth developing around the country, you need more access to some of these brands. And that's where Michael Kors, the basically founder of Capri Holdings, and Michael Kors, the brand, comes in handy, because one of his major value adds is taking these really well-known names, Jimmy Choo, Versace, et cetera, and making them more accessible to mainstream Americans by lowering down the price point, increasing the manufacturing. It's no longer an elite exclusive thing to get a pair of Jimmy Choo shoes. Sure, it's
It isn't?
expensive. It is. It's expensive.
How
but
much
it's not
are
as
they?
expensive as they were. I think a pair goes around for like $700.
Okay, that's luxury.
Hold on.
That's exclusive.
No, it is.
Yeah.
100%. But it's not as expensive as, like, say, the 2000 they used to go for. That's the point, before the acquisition. So the price point has actually come down and become more attainable. And if you go to any mall in America, there is a Michael Kors store there.
Yes.
That's not normal for a luxury
Michael
brand.
Kors, but can you buy Jimmy Choo shoes also at any mall in America?
No, but
Okay.
they're heading in that direction.
See,
It's far more accessible.
we have
You're Middle
no
America.
idea.
You're Ohio.
I am, but I'm not shopping for Michael Kors or Jimmy Choo. In fact,
You will soon, now that you're a girl dad.
well, we were trying to make the distinction between, something like Coach, which I don't think they would define themselves as a luxury product maker, and something like Versace, and they definitely would describe themselves as luxury.
Yeah. Well, Coach used to be, and they used to. This is, I think, the point. They used to be thought of as a luxury brand. I'll give you another example. With Coach, although they make 70% of Tapestry's revenue, you have Stuart Weitzman and Kate Spade. When you think Stuart Weitzman, do you think luxury?
I don't know who Stuart Weitzman is.
Oh my God, you're killing me.
Yeah,
you're
I don't know
killing
that
me.
brand either.
I'm in a studio full of guys. This isn't fair. I can't make my point. But Kate Spade, come
Yes,
on.
yes,
Okay,
Kate
Kate
Spade.
Spade is luxury. Yet now, if you go to any mall in America, you can find Kate Spade. If you go to 30 Rock or Rockefeller Plaza, there's Kate Spade. Same thing with Swarovski. There are these names that used to be very elite, very expensive, that are now far more accessible, far more household names, and that's because of this kind of move that Tapestry and
Kate Spade, I know.
Capri Holdings. Well done.
The thing is,
1
you're
out of
right.
6.
You're right about that, right? Because Kate Spade,
David Spade's
Coach,
sister or something.
Michael Kors, these are things that are all in the mall. And
Yeah.
not just the mall in the middle of Manhattan, one of
Yeah.
the most expensive cities in the world, but a mall in the middle of Columbus, Ohio.
Yeah.
Which is where I tend to go to malls.
Exactly.
So, but those things, they go down market in order to get mass market, right?
Right, and
Yeah.
but that's the value add. That's what Michael Kors has done with a lot of these brands, and that's one of his criticisms as well for the folks who are very high fashion. They're saying, look, you're cheapening the brand by making it so accessible and mainstream. But then if you look at the profit and the turnover, well, the top line growth for some of these companies that they're acquiring is immense, because all of a sudden you're accessing people in, I don't know, Wyoming, Ohio, Illinois, Texas, that you wouldn't have ordinarily, and that's a really big deal.
Is there a consolidation wave going on in the luxury space? And if so, why?
There definitely is, and it's simply because, one, in the U.S. specifically, I think it's going a bit faster than it is in the likes of Europe, for example. But the wave of consolidation in the U.S. is largely driven by trying to apply the European model to the U.S. and it not really working. So you have seen Tapestry and Capri Holdings separately, their stock has been tanking. These are companies that have been struggling relative to some of their international peers. But you're also seeing that wave of consolidation in Europe. You're seeing it in some of the Middle Eastern brands as well, because the Chinese consumer, which has been driving a lot of the luxury buying, has been slowing down.
Well, that's
as well.
why the news coming out of China, which is they're basically going to let the people move about and go anywhere they want. So that's
Yeah.
going to presumably help Chinese outgoing tourism outside of China, outside of Macau, where they've
Yeah.
generally been going, to Europe, to the U.S. And I hope to see our Chinese shoppers on Fifth Avenue, on Madison Avenue, like we used to pre-pandemic.
Yeah.
Because those folks have money and they like to spend on the luxury brands.
Yeah.
And I know the stores that are, again, on Fifth Avenue, Madison Avenue, they depend on those. And
I hope they're not buying as much or with as much money as they had been in the past, because they drove the price of some of the products that I like way up.
All right,
For example, Rolex watches on the secondhand market, those prices were far higher. I'm talking 2x, 3x, 4x of manufacturing suggested retail price.
Yep.
Yeah.
And they finally have been coming back down, high-end watch prices. And when I saw that story this morning, the first thing I thought is, oh no.
Well, the first thing I thought was Sam Fazeli, my wine expert, and he also covers pharmaceuticals for Bloomberg Intelligence. He's a big wine guy. He lives in London. He lives in France. Big wine guy. He was just explaining to me over the last 10 years how the Chinese have just really rocked the wine market and pushed prices, particularly for fine French wines, way higher. But they've been out of the market.
Yeah, it's funny how we talk about the Chinese consumer almost like we talk about the American consumer. I mean, of course, the U.S. spending power is still significantly higher, but now we actually have to worry about not just Chinese exports, but Chinese imports as well, which I think really speaks to the strength of the country as well. And to your point, on that headline, you saw the European brands, specifically like of Richemont, for example, all rally this morning in the European session. So a massive move there. And I'll also add, I mean, we're talking about China and the U.S., but I really think the Middle East is worth thinking about as well. Because if you go to London, you go to, what's the high street in London? I should know this.
I mean, I like the King's Road.
Kensington. If you go to like anywhere in Kensington or Chelsea or whatever, there's so many Middle Eastern people, so many Middle Eastern shoppers.
And the cars they have, which are pretty cool. So I'm looking at Tapestry. The stock's down 11.5%, so I guess the market doesn't like, because they paid a big premium here.
Yeah,
for
it's like a 65% premium,
and not that the market's not liking it for Tapestry, so maybe a dilution concern there for those investors.
Oxford Street.
That's
is another one. I mean, there are a number of high streets in London, and it's funny to hear that question from you, because the term high street, I think, is a British term, right?
It is.
And you're going to be moving to London soon.
I am going to be moving
So
to
you'll
London
be
soon.
walking up and down Oxford Street.
Is she going to acquire a little bit of an accent, do you think?
No.
When she goes over there?
I'm going to go over. I'm going to start saying y'all and Colby.
I was going to say, she's from Dallas, and she doesn't have an accent from there.
Right.
So,
Well, that took work. I went to UVA, and the first thing they asked me was, did you drive horses to school in Dallas? And I said, no, but why would you think that? They said, because you say y'all every second word. That was the end of it.
Well, sometimes, even in Virginia, you go to Southern Virginia.
It's
I've
true.
come to embrace y'all, to be honest.
Have you?
It's a very useful word.
Are we planning
As opposed
a
to you
going
guys.
away soiree?
Oh, well, don't ruin it.
Oh, it's a secret. Oh, never
For what
mind.
it's worth, Matt plans all my soirees. He threw me a little birthday soiree.
When are you going?
That's true. That was delicious.
End of
red
the
velvet
month.
cake.
End of August.
End of August.
Oh,
Anyone want to
interesting.
come over and pack? Because that's fun.
That's right. Okay. All right. So Kriti Gupta with the reporting here today. A little M&A trade in the luxury Tapestry buying Capri.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's put this into context. Lydia Boussour can do that. She's a senior economist at EY Parthenon, and she joins us here. Lydia, what's your take here as you dig into some of the inflation data we got today?
Sure. I mean, the report was encouraging. We saw that back-to-back, the smallest back-to-back increase in core inflation, as you mentioned, since early 2021. We also look at those 3 months annualized trend for both headline and core inflation. And here as well, we saw a significant slowdown. If we dig a little deeper in the component, we are seeing that this inflation in used car prices, which declined in July, and we think that there is more downward pressure coming. And on the housing front, we have also seen a turn in housing inflation, and we're starting to see also some gradual disinflation. So overall, I think it's one more step in the right direction when it comes to inflation.
Can you look at, for example, car prices coming down? Can you look at the credit that's being given out for those kind of loans to help you forecast what's coming? Because I noticed that non-revolving credit actually jumped quite a bit last month after stagnating for a few months, and a huge part of that was car loans. My concern, Lydia, is that these numbers bounce back as the economy continues to do so well.
They do. I think what we've seen in the auto sector has been quite unique. we still have this imbalance between the supply and demand, and that has created some volatility in the sector. So I think, when we look at auction prices, they tend to lead used car prices in the CPI. So I think that we're likely to see more downward pressure, but there's likely to be some volatility as well, as you're pointing out.
All right, Lydia, given what we see on inflation coming down, the Fed appears to be standing pat, maybe one more rate increase. How do you put that all into context with an economic outlook here? Are you guys thinking that there is a recession in the near term? I mean, I know a recession is going to come at some point, but are you in the camp that says it's near term, or can we put this on the back burner a little bit?
Sure. In terms of inflation, I think we're heading in the right direction. I think the Fed will look at these numbers as some convincing progress. When we look at the economic outlook, at the same time, we've seen some economic resilience, but we do expect to see softer economic momentum in the second half of the year. So if you look at economic growth, we are anticipating to see growth, flirting with essentially zero heading into 2024. And at the same time, inflation is also likely to remain in that disinflation trend. And overall, that should make the Fed, comfortable enough to stay on the sidelines. And we do think that the Fed has reached the end of its hiking cycle, and that the July rate hike was the last one.
And even if we don't see core inflation continuing to come down, I mean, everyone's kind of taking a victory lap today, but it's still CPI minus food and energy year over year, 4.7%. That's more than twice as much as the Fed wants it to be. So don't they need to at least be seen putting some pressure on, actively driving it down until it gets to 2?
Yes, that's right. The Fed will be very careful. I think that if they do pause in September, they will retain a hawkish bias, and they will keep the door open to further tightening if the data justifies it. The Fed is really data dependent. We're going to get another CPI report in August. We're likely to see some renewed upward pressure on headline inflation. We're also seeing, oil prices rise again, and that's potentially likely to lift headline inflation as well. But we do think that core inflation will continue to ease further towards the end of the year. There's a lot of disinflation baked in on the housing front, and that's likely to pull down core services inflation. And the Fed will be looking at that as some progress towards getting inflation back to their target.
Lydia, so it seems like inflation is, trending in the right direction here in the U.S., but how about Europe? It just seems so much more entrenched there, particularly in the U.K. What do you expect the central banks across Europe to do?
Yeah, I think in Europe, we're seeing inflation dynamics that are still elevated, but we've also started to see some progress. We're seeing very tight labor market conditions in Europe, and that's one factor behind the resilience of inflation. As we look ahead, I think we've seen that slowdown in the pace of tightening also in Europe, and they're likely also to reach the end of their tightening cycle this year. I think when we look at the Fed, it's a little ahead in the cycle. As I said, we're probably at the end of the hiking cycle, and we do see the Fed cutting interest rates likely in March, not before March, but likely next year as they start recalibrating policy.
All right, so the economic picture, though, is different for Europe, right? I mean, here we're looking at still more than 2% GDP growth, and over there, they're already stagnating. Do they hit a recession?
There is a high chance, I think, that we could see some recessions in Europe. We're likely to see, I think, across most advanced economies, economic growth, flirting with full speed growth, essentially, this year. And so I think that really when we look at global growth, Europe, US, and are likely to be those economies slowing down growth, and we're likely to see global growth slowing this year and then gradually rebound into 2024.
Lydia, 30 seconds. What's your labor forecast here? I mean, are we going to see unemployment go above 4% anytime soon?
Yes, we do have, a further softening in the labor market. We think that this gradual rebalancing that we have started to see will continue. So we expect to see a gradual rise in the unemployment rate towards, a little above 4% by the middle of next year. And that's going to reflect the fact that labor demand is going to cool further. We're already seeing that happening, and hiring slow down further, as well as we have softer demand and softer economic conditions taking in the economy.
All right, Lydia, that's really, really helpful. We really appreciate checking in with you. Lydia Boussour, Senior Economist, EY Parthenon is the firm.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, the markets like what they saw from the inflation print today. Let's check with somebody who actually does this stuff for a living. Aadil Zaman, he is a partner for Wall Street Alliance, joins us live here in our Bloomberg Interactive Broker Studio. Aadil, I like the print today. Matt thinks inflation's still too high. I'm a friend of the trend. I like the trends coming down. That's what I'm focusing on. How did you view the CPI print today, and how does that impact kind of how you're thinking about these markets?
So great to be with you. So we were very positive on this print, and the Fed waged a war against the 40-year high inflation by raising interest rates to a 22-year high, and it's clear that the Fed has won this war, right? Inflation has come down from around 9% down to around 3.2%. I think this is constructive for the equity markets in the long term.
Are you not concerned that there's a chance it comes back?
Well, what we think is that from this point onwards, the inflation will most likely start to cool off on its own, because even if you look at the unemployment rate, we think that it is understated right now because a lot of the layoffs have been in the tech space. And a lot of those workers are high earners, so they're not necessarily claiming unemployment benefits. And also, the Fed is going to be very careful about not damaging the unemployment rate too much in this politically charged environment. So we think it's going to start to cool off on its own from this point onwards.
I just saw total consumer credit rose $17.8 billion last month. There was a small monthly increase before, so credit had kind of stagnated, but now it's come roaring back, especially student loans and auto loans. And if people are able to weather 7 or 8% auto loans and are still willing to go pay these incredibly high prices for vehicles, I feel like they could push inflation higher. They could bounce it back up.
Fair point, but I also feel that at some point this excess savings that people have from the pandemic, they're going to run out of it. And when they run out of it, they'll start cutting back on some of the services, right? So they'll stop going to Bloomingdale's and they'll start going to Costco, right? So they'll become more budget conscious, and I think that will also start to bring inflation down, and the data is supporting that.
All right, so given that backdrop, Aadil, a benign inflation outlook, still decent economic growth, although slower than what we've seen, what do you do here? Are you equities, fixed income? Where do you start?
Well, fixed income is also very attractive over here, but if we take a longer term point of view, I think equities is where you get the most bang for your buck. We are of the school of thought that we think in the short term you're going to get a correction in the market because seasonally this is a weak period of the year. So on the equity side, we would be looking at opportunities on a pullback. The two parts of the market that we like over here is the high quality momentum areas, and then the less loved stocks that haven't participated in the rally so far. So we would be looking at opportunistically on those areas on a pullback.
All right, so is that the Metas of the world, the Googles of the world, the Amazons? You'd buy them on a pullback, or kind of what's that first group for you?
Yes, so that would be, certainly that's one group of stocks. The stocks on our watch list, for example, Apple and Meta.
Okay.
Apple just came out with their earnings. The street did not like it because the iPhone sales went down. But we actually saw strength over there because we saw their service business grow, which is, the profit margins are almost double that of the product business. So those are the type of areas that we would be very interested in on a pullback.
What do you think about, rates at this level? You're going to want to lock those in. Don't you think that a lot of people are going to want to lock in 4%, 10 years?
Yes, actually, we have a lot of clients that have cash that are looking to lock in good rates. So certainly, I think that's in the short term that is going to be a headwind in the market. But I think that in the long term, you get better risk-adjusted returns on the equities.
All right, so I mean, Matt's been overweight. Those Magnificent Seven. Me, not so much. So if I'm looking for this market to kind of broaden out a little bit, because I think I need to see that for just the health of the market. If I don't own the Magnificent Seven, if I don't want to go chase those things, where do I go?
Yes. Or should I take profits and get in?
You let it ride. Just let it ride.
Well, I agree with you completely. Like if you look at the S&P 500 up until the end of last month, it was up about 19.6%. You look at the equal weight index, it was up about 9.6%. So I would be looking at some of the less loved stocks. Like, for example, another stock on our watch list is Home Depot. Right, so Home Depot did really well during the pandemic because we were trapped in our homes and we just wanted to improve our living experience. Since then, the demand has subsided, but we still see a great long-term potential because in the US, we have a housing shortage and people do have to upgrade their homes, which benefits a company like Home Depot.
And you own Home Depot. You also own Apple. I feel like the market has soured a bit. Well, clearly they've come down below the $3 trillion value, and we see iPhone sales stagnating. Why do you own Apple longer term?
So we think that, the service business, there's a lot of strength over there. So we like that. And then also we think that the iPhone 15 release could be a significant upgrade. The quality of our phones are improving. So we are holding on to our phones longer before we upgrading it. So I think this upcoming release of iPhone 15 could be a good catalyst. So, and company pays a good dividend. So
I just don't know what's going to change. The phones that Paul and I have are already capable of everything we need to do.
I got an iPhone 11.
Yeah.
That's what I got. I might upgrade, though. I'm going to take you to task on this Apple. Every time I see Tim Cook, I say, you got to raise your dividend. You got a dividend less than 1%. Man up, go to 3%, 3.5%. Are you surprised that they don't do that with all the cash they have on the balance sheet, all the free cash flow they have? Don't you think that they should raise their dividend?
Well, yeah, I mean, they're entering into a different phase of the business, and I think they are doing great with the share buybacks. And I think, I think they have a lot more going on for them in other areas, which they want to keep their cash to take advantage of.
How about energy? There's a sector that for a decade nobody cared about because it was peak oil and we're all going green, and then it's had a nice 3 years here, and now we've got WTI crude oil, back up at almost $84 a barrel. Do you guys traffic in the energy space at all?
We actually think oil is headed higher because the demand for oil, as the global economies grow, the demand for oil is going to continue to increase, and OPEC is going to continue to limit production. And the transition away from fossil fuels is going to take a lot of time. So we actually think that the oil inflation is here to stay, and that will keep going higher. And that benefits some of the larger oil players because their break-even on oil is very low. And with oil at $100 a barrel, they're making a killing.
Aadil, does China play into your investment thesis?
Certainly, China is a major player, and it does have an impact. But we find opportunities more domestically in the United States, and especially.
I just mean in that they, their economy supports rising prices of oil if it does well.
Yes, so China is definitely a key player there. Global economies, India is a key player, and the U.S. also. The U.S. economy is improving, so that's also increasing the demand for oil. So definitely, we really like some of the larger oil companies that benefit from that.
30 seconds. What are you staying away from here?
I think that there's a lot of quality investments right now that you can take advantage of. So I would stay away from the high risk, volatile, meme type of investments and just focus more on quality and look at it in pullbacks. And like you said, fixed income is giving you also an opportunity of a lifetime. 1 year T-bill, you're looking at close to 5%.
Yeah.
We've never seen that in a long time.
Yeah, it's just amazing. I know people that just roll those things over all the time. Aadil Zaman, he's a partner at Wall Street Alliance. We appreciate you coming in here.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hannah Elliott is going to join us right now.
She's there.
From Los Angeles. Yep. She is getting ready for this great Pebble Beach
Concours d'Elegance.
Concours d'Elegance. You've been there a few times.
Done there
I
many,
have
many
never.
You've got to go.
I
there.
have
It's a
never
bucket list for
been.
you.
And it's like everybody I talk to is like, oh, how can you not go to that? I just haven't really ever had time or been allowed by my boss. But Hannah is like, it's her job. So she joins us now. Also, I think preparing to drive a couple of sweet Aston Martins. Hannah, talk to us first about the Concours d'Elegance. And I saw your story about they're building a big barn for some old Ferraris. What's that all about?
It's honestly so exciting and cool. I'm really excited. I've gone for many years, and this is the most excited I've been for a while about a bunch of old, rusted out, completely derelict Ferraris that are for sale. R.M. Sotheby's, the auction house, built a barn display to recreate the way that these 20 Ferraris were found in Florida after a hurricane. You might remember 2004, we saw some pictures of a bunch of Ferraris completely demolished after a hurricane. Now we have the Ferraris for sale. They've reappeared. And they're actually owned by a very eccentric man you might remember named Walter Medlin, who's got quite a colorful history back to the 1970s or so. But these Ferraris are gonna go big, even though they're all twisted and completely rusted out.
Talk to us about the Concours d'Elegance. What is it, and who goes there? Tell us about why it's so special in the world of high-end automobiles.
Okay, well, Concours d'Elegance is a really snooty way to say a car show.
Yep.
And what it is a bunch of really nice, very well washed and detailed cars parked on a putting green and a fairway of a golf course.
And on Ocean Avenue in Carmel by the sea.
Exactly. It's actually on the Pebble Beach golf course. And there is a set amount of cars that are judged, of course, you know, this Q-tip white glove type judging. But then also throughout the week, there are auctions, there are other car shows, you know, thousands and thousands of people come. There's kind of something for everybody. There'll be car shows just for muscle cars or just for Porsches or just for, I don't know, old trucks from the 70s. It's really fun. But yes, to your point, the big climax of the week is Sunday's Concours d'Elegance, the car show on the Pebble Beach golf course.
Yeah, it's just extraordinary. I mean, this is big business, Hannah, right? I mean, I see stories on some of those cars that get bought and sold during the week, and particularly on Sunday, some huge numbers. There's real investment here.
Yeah, this is kind of like art collecting in a way. We're talking about blue chip collectibles here. So the most expensive and rare vehicles in the world are bought, shown, and displayed. Certainly the auction houses will see easily over $100 million in sales just over the weekend, all told, through 3 or 4 days of auctions. But you know, you have things that, you know, there might be 2 or 3 of them in the world. Some of the racing Ferraris, of course, we remember the 300 SL Gullwings, the Mercedes with the doors that raise up like a Gullwing. So really iconic cars. This is the most prestigious car of it, really, certainly in North America, maybe in the world. You could say there might be a few in Italy that compare, but this really is, if you want to see blue chip cars and the best of the best and the rarest, this is where you go.
We're showing some of the derelict Ferraris here for those people watching on YouTube or streaming us on Bloomberg.com. Some of them look like they're in pretty fantastic shape. Others look like they're about to fall apart from all the rust. But they're still expected, even the one that, Hannah, you know, the one that's completely crumpled and doesn't have a roof or maybe even wheels, even that is going to go for hundreds of thousands of dollars.
Yeah, you know, barn finds are very interesting things. From what I hear, the guys that I talk to, really, if you're concerned about money, it's better to just buy the car already done. These are not especially, at this point, you know, you're going to spend a lot of money to bring them back, maybe even more than you'd spend on a similar car that's already done. So it's really, at this point, it's about the story, it's about the journey. The people who buy, you know, these twisted, crumpled cars are people who love the painful relationship of what it takes to bring a car back to life.
Let me ask about a new car, and that is the DB12. You've already driven the car somewhere else. besides America. But you're also going to get some seat time in a couple of Aston Martins coming up. What's the story with this company, where it is and what it's producing?
You know, Aston Martin is really fascinating this year for a number of reasons. We know that they've really struggled since their IPO in 2018. They've got a very dynamic owner in Lawrence Stroll. And of course, Aston Martin is doing fantastic in Formula One right now, which helps a lot, at least from public perception and probably fundraising too. Of course, Lawrence Stroll's son is a race car driver as well. So there's a lot of talk about Aston Martin. And then when they bring in the DB12, which is a successor to the DB11, excellent vehicle. They've got the DBX SUV, the 707. I think I'll be in during Monterey. Fantastic SUV. I actually think you could cross-shop it against the Lamborghini Urus, perhaps. And you could throw in the Ferrari Purosangue as well if you wanted. So they're making really competitive products, but also they have really, it's been tough. You know, they faced liquidity issues. There's been a lot of financial turnover and executive turnover. Now we also know that they're tied in with Lucid. So there's just a lot going on at Aston Martin. It's a really exciting time, and I am looking forward to having some time with their executives to get the latest.
All right, Hannah, great stuff. Enjoy Carmel, enjoy Pebble Beach. Maybe get a little veal at Il Fornaio on the corner of Ocean Avenue there in Carmel by the Sea. Hannah Ellis, staff writer for Bloomberg Businessweek. Man, we got to get you there, dude.
Someday, you know.
And you go for multiple days, and as Hannah was saying, all around the Monterey Bay area, including Monterey, out near Salinas, all over the Monterey Bay area. Each day there'll be different shows, and you know it's not just there. So it's just amazing. And then it culminates on Sunday.
I mean, the next best thing for me is just having Hannah cover it, because then I read all of her coverage and get deep in it. So I feel like if she's out there writing about it, maybe creating some video content as well, that's good enough for me for now. And then one day when I retire, maybe.
No, please. You can go out there. I'll make it happen. Don't worry. I know a couple people.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt Miller and Paul Sweeney here, live in the Bloomberg Interactive Broker Studio. We are streaming on that YouTube thing, so go over there and just search Bloomberg Global News, and that'll bring you to the video feed. How fun is that?
Bloomberg Global News.
Bloomberg Global News.
You've got to put in the phrase Bloomberg Global News. No, I'm just saying, like, I have searched and searched on YouTube, and I can't find it, but for some reason that's a magical phrase. Bloomberg Global News.
I know.
I don't know why.
It's crazy. I learned that from Carol Masser, because they've been streaming Bloomberg Businessweek for a long time, so she taught me well there. So, all right, looking at the markets here, up 0.4% on the S&P 500. Let's see where the action is under the hood. Billy Lipschultz, he covers the markets for Bloomberg News, joins us here in our Bloomberg Interactive Broker Studio. Billy, what are you looking at?
Yeah, still seeing quite a bit of weakness for Tapestry after the deal to acquire. The deal to acquire Capri in an $8.5 billion deal. Tapestry down 13%, worst performer in the S&P 500. The biggest driver to the upside, though, among them is Disney after quarterly results showcasing cost cuts, which will be interesting ahead of News Corp results after the bell today. So getting a bit more detail, Paul, as you mentioned, in your neck of the woods within the media space. One stock that does stand out, though, Yeti Holdings. I don't know if you guys are
huge Yeti fan.
Okay. I'm a big owner of Yeti products. Full disclosure here.
I've got the cooler. I've got a couple of the tumblers. Stock up 21% right now after better than expected second quarter results, boosting their forecast for earnings for the year. So biggest intraday percentage gain since November, trading at the highest since February. Analysts across Wall Street really praising those results.
All right. It is ridiculous how good those products are. I'll put the water in my Yeti little container, go to the beach. I can barely touch the exterior of the bottle because it's so hot from the sun on the beach. Drink the water, ice cold.
But why is Yeti the only name we know?
Because we grew up with
Coleman,
all that stuff.
Or Igloo.
Igloo, that's the one.
Exactly. And I don't know if they make the same kind of products, but there are other cooler makers who make, I think, what's called roto-molded coolers, right? Arctic Coolers is one. Orca is another. I'm pretty sure Pelican makes them as well.
I don't.
But
Based
you
in
don't
Austin,
see
Texas.
anything besides Yeti. If you go to an REI, for example, it's all about Yeti.
Well, even if you go to Dick's Sporting Goods or Lowe's and Home Depot, there's an entire Yeti section, wine tumblers, the regular tumblers, mega ones that are like
My brother's
42 ounces.
fiance has a Yeti martini glass.
You're lying.
No.
She's welcome in the family.
Exactly. It's essential to her lifestyle.
It's a lifestyle aspirational brand.
Well, it's interesting too. They make backpacks now. They make clothing. It seems like they're really branching out into kind of the mainstream consumer goods outside of just coolers. Because I remember at one point when the stock was trading down back in 2021, it peaked above $107. Right now, below 50, and we were kind of calling out like, how many tumblers can a person buy? I mean, my brother's got the backpack. He's got the 12-pack cooler, but like, other than once you hit kind of...
Now, does your brother also wear a white baseball cap and talk about his frat all the time and have an Old Row subscription?
No, my brother's actually he's in that blue-collar working class, so he's one of the construction guys who has the cooler loaded up for...
You got to have that.
Yeah, they have it too, but I always feel like I risk, if I put a Yeti sticker on my truck or, if I wear the hat, I risk being lumped in with that whole... good old boy crowd.
I don't know.
It's weird.
Aren't you a good old boy?
I don't go to SEC games,
I'd love to go to SEC games.
But I feel like Yeti's interesting because it has that kind of, fraternity vibe, but also the like construction, firefighter, police officer.
True.
Kind of
Yep. Yeah, look at that chart. That's another pandemic chart. Stock, in 2020 just started ripping. Went from like $20 up to $100, and like a lot of those pandemic stocks at the end of 2021 were peaked, kind of been coming down ever since.
Another stock in focus, though, and Matt, I wanted your opinion on luxury, not luxury. Ralph Lauren right now down 2.5%, falling for the fifth straight session after they reported quarterly results that had a light 2Q forecast. Our Phil's call him a luxury brand. Ralph Lauren luxury or not luxury?
I mean, to my mind, it's a staple.
Horse.
To my mind, it's a sort of staple of the upper middle class, right? And they do make higher end products. The Purple Label is one. They have RRL, but they don't actually achieve full luxury, I think, because for example, RRL likes flight jackets and Japanese denim kind of products, workwear sort of stuff. They don't really have the quality that the truly good brands in that space have. They just have the design.
All right, it's $8 billion market cap, up about 18% year to date, and down 2.7% today on that print, right?
Yeah, after those results. Yeah. Right. One of the things that I thought was interesting is that they derive more than half their sales outside of North America. So
really?
Europe
Okay, so
and
that's
Asia are making up a good chunk of that.
It'll be interesting to see. I'm going to be really fascinated to see now that China's opening up air travel for or loosening it, I guess, a little bit for its people, whether we'll see an outflow of Chinese just visitors and travel. Do they have the same pent up kind of revenge travel?
They did. They're allowing group travel.
Yes, I saw
so they're
that.
allowing like tour groups now to leave China for destinations like the U.S.
So I guess that's a good first step, but maybe we'll be seeing some more of our Chinese friends here in the big city shopping in some of those big luxury stores. We certainly like to see that. Anything else, Bailey?
Hawaiian Holdings down 4%. This all coming after that news out in Maui. So we're keeping an eye on that. Obviously, not a positive update in terms of kind of the news that's coming out of there, but keeping an eye on
that
stocks
story's
that are exposed to
unbelievable.
that.
I mean, the fires. I'd never remember seeing them, hearing about fires in Hawaii before. So I don't know if this is a new thing, but boy, and just the destruction of that beautiful area. I guess it's on Maui. Crazy story.
The former capital
Yep.
of Hawaii has been decimated.
Yeah, it's just terrible news. All right, Bailey, thanks so much for joining us here. Bailey Lipschultz, he covers all the markets for Bloomberg News. I want to talk about endowments. I know a thing or two about endowments, having worked on some boards of schools, and for a lot of schools, it's the lifeblood. It kind of supports the economics of the school. And some of these big universities report their endowment numbers pretty publicly. And Janet Lorin, higher education finance reporter for Bloomberg News, joins us here in our Bloomberg Interactive Brokers studio. How did some of these big universities do in this last fiscal year, which I guess ends in June 30th?
Yes. So
Okay.
we'll be starting to hear more school-specific returns coming up in the next month or two.
Okay.
We get a good snapshot And the median is 8.7%, which might sound like a terrific return, but we have to keep in mind inflation. So while you have to factor in spending and also what schools are paying out in terms of inflation, they're also paying higher costs for everything from construction to professor salaries. They're even paying more in financial aid.
Yep.
So those, it may sound like a great return, but a lot of it is being eaten up by inflation.
I have to imagine financial aid spending has gone way up over the past couple of decades, because so many, I focus on the schools with the big endowments that you write about, so many of those schools have hardly any students who are paying full tuition.
Well, a lot of the schools have been trying to make a concerted effort, to showing Congress and the federal government that they are attracting lower income students. Harvard said this year 25% of their entire freshman class has an income of $85,000 or below, and they're giving more financial aid for students who are, trying to have a more diverse and economically diverse class.
You like Columbia University, don't you?
Yes, I did go to school there.
Undergrad at Columbia, master's in journalism from Columbia, then a Spencer Fellow from Columbia, which you finished this year. What is that?
So that is a reporting fellowship looking into education reporting.
Everyone who comes in here is so much smarter than we are. Everyone from Bloomberg News that comes in, I'm just like, you guys killed me. All right, so going back to your story here, talk to us about endowments. How important are they to these schools? Because it just seems like, I do a lot of work with Duke, and their endowment's monstrous, and they get great returns. And it's such a big supporter of everything they try to do. But most schools don't have that.
Right. Well, and there's a handful of schools that are extremely reliant on the returns. Schools like Princeton and Amherst rely on more than half their entire budgets from endowments. I think in some cases they're 60%. But, when you look at smaller schools, their endowments are smaller. They're in U.S. equities, and, they did much better for their returns this year, given that equities were up about 18% in the period. It just depends on the school. And as, long-term returns were about 6% for the 10-year average, which is not a great return considering inflation and what they're spending. They actually have to earn a lot more in order to keep pace. So, we'll see as these numbers come out how the schools are doing. Last year was a terrible year, the worst year in return since the Great Recession.
But, okay, here's
10%.
my big but here. Alternative investments are, particularly for the larger endowments, are a huge percentage, and it shocks people how much they're putting into hedge funds, private equity, private credit. 30-40% of their endowment they're putting into these things, which don't have probably more as some of the bigger ones. They don't have liquidity. That's the downside.
But they make returns.
Okay, there's this thing called mark to market. Mm-hmm. They did not mark to market the down 25% year we had last year. I didn't see it anywhere in the endowments. Why?
But why would they have to? It's not the same as a bank.
No, but it's an endowment, and I would think they would have mark-to-market regulations as well.
I don't believe they do.
I don't believe they do.
I can't imagine
and
why
that's
they would.
why, and it's interesting because I kept, when I listening to the board meeting and Duke, I was like, okay, but what about the 40% we got in, some leveraged thing that's in Zimbabwe or something, some, zinc mine? Where's that?
Well, most of the larger schools, you're absolutely right, are mostly in alternatives. And that was a big shift starting in the late 80s, early 90s, when David Swenson, the late CIO at Yale, decided that schools could get a better premium for illiquidity. And most schools, really the big ones, shied away from U.S. equities. And in some years, it's really paid off. In this year and in years past, you've seen smaller endowments with larger shares in U.S. equities have much better returns. And of course, they're not paying the fees that alternatives command.
Well, tuitions across the board continue to rise, right, Janet? And how long can that happen, especially as it becomes a national issue that people owe so much money in student debt?
Well, I think 20 years ago, we would have been surprised at the price tag that it keeps continuing to rise. Now, however, if you look at the share of student loans, the biggest share is not actually for college, it's for graduate school, because you can really borrow a lot, up to the cost of attendance for graduate school, which could be, $80,000, $90,000 in a year. For a federal student loan for your freshman year, you're limited to $5,500, $6,500 in the second year, and $7,500 in the third and fourth year. So the biggest share of student debt is really from graduate school. Yes. Yeah, there's limits.
Okay. You know, Dr. Joel Fleischman had $125,000 of debt.
Did he really?
He paid it off in Alaska.
Which is why he had to go to Alaska. Exactly. He went to Columbia Medical School.
That's right. I remember that show.
The show is called Northern Exposure.
Great show. It's now on Netflix. There's a write-in campaign.
I just bought
to get it.
I'd been searching for it for years.
I know.
And I could never find it.
And who's the guy?
Any
Rob
streaming
Morrow.
service.
He's a guy. I follow him on Twitter because he does a lot of really good stuff, including he's on Billions now. But I follow him on Twitter, and he's saying everywhere I go, people say, "How come Northern Exposure is not on Netflix?" It's now on Netflix.
And I just bought it $60 for the whole first season. It's very expensive.
Really?
Oh, can you send that password to me?
Yes, that's right. But there's password sharing. All right. Talk to us about, I've got my last of my offspring, my 4 offspring, going to this freshman year in college, a private university. The tuition starts with an 8.
Oh, my goodness.
Exactly. I'm just like, holy cow. And there's no end in sight, is there? To me, it's going to take an act of Congress.
I'm sending my kids to school in Europe because it doesn't make any sense to me.
Well, and when we talk about student loans, and you hear this chatter about $10,000, which of course is not happening. It never addressed the root cause, which is the increasing cost of college. So you're right. There doesn't seem to be an end in sight, and there's no real regulation. And when you're looking at default rates for colleges, they're never on the hook. They don't have skin in the game. Yeah,
it's just extraordinary. It doesn't feel like, it's the best university system in the world, arguably. But boy, the economics are tough for the average person out there. Janet Lorin, thank you so much for joining us. Janet Lorin, she's a higher education finance reporter for Bloomberg News. And no diversity in her education. It says Columbia. It's a good school and all, but try something different.
Good.
It's pretty good. Yeah, it's pretty good.
They have a pretty good journalism school as well.
Oh man, I know they have very good. They have a great business school too. I've been hiring people out of the Columbia Business School forever. And a good history department, good to know. I'm sure everything's good there. It's Columbia.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Just head over to YouTube and search Bloomberg Global News. Or you can just go Bloomberg Radio now,
yes.
I believe. It's even simpler
to
say
we just
Bloomberg
learned
Radio.
this. Just search for Bloomberg Radio.
Okay, that's easy.
Yeah.
All right, then you can find that. All right, we can do it. Anyway, as Charlie was just reporting, Disney reported some numbers after the close. Stocks up 4%. Lots of cross currents there, reflecting a lot of cross currents in the media industry as this industry tries to shift from a traditional model, which was based upon lots and lots of people paying the cable companies and satellite companies a lot of money every month, to one now, everybody's streaming. And what does that do to the economics? Ian Whittaker joins us. He's a managing director and owner at Liberty Sky Advisors. He's based in London, England, one of the smarter folks I talk to about the global media business. Ian, thanks so much for joining us here. First, what'd you make from Disney's results last night? And can you extrapolate that out to just kind of how the global media industry is evolving?
Yeah, no, it's a very interesting one, and what would say, well, first of all, in terms of extrapolation, as you say, there's a lot more focus now on cost control and efficiencies. So, and this accompanied the rise in interest rates that we saw. The market shifted from strategies that were based on growth to ones that essentially emphasized with cost control as well. And that very much was the story that came across from Disney. When you look at the management remarks, very much focusing on what they had done about reducing capex, what they'd done about cost control, been more ahead of expectations. There is a flip side to that, though, which is if you are going to focus more on that side, then what it does mean is that you're essentially saying the growth, the future growth potential, is probably lower than you expected. And so I think the message that we're getting, particularly in the streaming space, from all of these companies is the markets want them to be more financially disciplined, and that's fine, and they're obviously taking steps to do so. But really the underlying message that is coming through is that we think the potential future growth within the market is far less than we anticipated several years ago. And again, you can see that in some of Disney's comments. They were talking about that not all markets will be equal for streaming. Their comments on Hotstar in India, essentially saying we dropped 24% year on year in terms of subscriber numbers, but essentially don't worry because it doesn't have that much impact on the financials. Such a statement probably would never have been made 18 months ago. Now, I think that has some very interesting implications when it comes to valuations, because maybe not so much for a Disney, although it's part in there simply because it's a constituent part of different entities. But if you take stocks like Netflix, for example, probably the valuations where they are at the moment still very much reflect a consensual view that they are still long-term growth stories, and probably long-term high growth stories. I would question whether that's the case for many of these players.
What do you think about the profitability of streaming services? Paul was talking to the head of SAG-AFTRA, I think last week or 2 weeks ago, and she was saying these streaming services make $30 billion a year in profit. They want their take. Do they actually make that much money?
No, I have absolutely no idea where she actually got that number from, because that just does not make sense. I mean, if you look through the results from these companies, the main streaming companies globally, yes, Netflix has an operating profit, but people like Disney are still making losses. Obviously, Peacock, several $1 billion losses this year as well. Warner Brothers, yes, again, has brought down the amount of losses, but nobody is near profitability yet. I think this is going to be a very interesting question. Sort of, I mean, my view is in the next 5 to 10 years, this will be a core paper when it comes to MBA studies as to how, quite frankly, these companies traded in what was a model that worked very well for them, i.e. the established pay TV model, but essentially one where the economics are just a lot tougher because they were not naturally D2C companies. They've had to go out and do a lot more in terms of marketing. It's uprooted the economics of their content businesses as well. I think the argument that this was inevitable, I don't necessarily buy that. I think there could have been sort of areas where some of the companies that have been smarter could have taken different strategies. Sony, for example, I think has adopted the right approach, which is to say, look, we don't want to have a D2C business, but what we will be is we will be the arms dealer to everyone else. If they want our content, then we will sell it at the highest price. And I think that's exactly the right strategy, particularly for, let's call them second-tier players within the market. But I think what we will find over the next 5 years is that what will happen with streaming is that streaming, if there is going to be any profits, they're going to be limited. But what's going to happen with the major media companies is, from a financial standpoint, especially in the US, they're going to be outgunned by the tech companies when it comes to sports rights. And I think also as well, what I suspect we will then start to see is sort of a reversion back to the idea that streaming isn't the central focus of everything. I think, again, this is what you've seen from Warner's, talking about that the streaming tail should not wag the corporate dog.
Well, Ian, I mean, then that kind of goes to the question of, are these stocks even investable here in the process while this industry is trying to figure out how to generate better profits and better returns? It almost seems like you can't invest in this space in general outside of Netflix.
I mean, what I would say is that I think there is, for each of the, particularly for each of the streaming companies, I think there is a major question about how they have come about, how they have adopted their strategies over the past several years. And what do I mean by that? Well, let's take a Disney. Yeah, what it said yesterday. The three core components are theme parks, streaming, and studios. Well, it was only around 2.5 years ago that people were pretty much sort of willing to write off the films business.
Yep.
Essentially saying that the way that we watch films is dead. Yeah, it's all going to be about direct to streaming, and essentially the idea that people will go in a post-pandemic world to go and watch movies in the movie theater is just ridiculous. They made major strategic decisions based on that. And now what they're having to do is reverse those out as they find out that the decisions they made were wrong. I think streaming, again, is another example, as I explained before. I think there are ways that each of them could have looked at their strategies and gone about this in a different way. So I think, with none of these companies, I think companies are at different levels. as to where they are along their strategy realignment. For me, for someone like Disney, I think there is still a question mark as to have they really got their strategy fixed.
All right, we're going to have to leave it there. Ian, appreciate it. Ian Whittaker, Managing Director and owner at Liberty Sky Advisors.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.